Audio connectivity. Audible. Audio check. Audio connectivity. Sorry, good morning. Am I audible?
Yes, ma'am, you are.
All right. Okay. Just make sure that your mic is working fine.
Is it working fine? Am I
It is,
am
it
I
is. And
audible?
your video is also visible. All right.
Okay.
Good morning, everyone.
Good morning, ma'am.
Good morning, everyone.
Good morning, ma'am.
Good morning, ma'am.
Very good morning, everyone. Those who are having any difficulty in joining, may please scan the QR code given in the poster, which will redirect them directly to the YouTube live video link. So, again, very good morning, everyone. I welcome you all to this online lecture on contemporary issues in auditing to be deliberated by CA Obhijit Bandyopadhyay, our guest speaker for the day. Um, I am confident that this session will provide us with valuable insights and a deeper understanding of the evolving audit landscape. Mr. Bandyopadhyay is an alumnus of St. Xavier's College, Kolkata. He is a chartered accountant and MCOM holder from Calcutta University, as well as has a diploma in information systems audit from ICAI. In a career spanning more than 30 years, he has served as partner, audit and assurance in Deloitte Haskins and Sells, and also as partner in DP Sen and Company. His work is a guiding light for students, peers, and educators alike, inspiring all of us to strive for excellence and embrace the transformative power of education. Without further ado, I warmly welcome Mr. Bandyopadhyay as we eagerly await the insights and wisdom he will positively share. Thank you, everyone.
Let me know, should I start?
Yes, sir. You may.
Okay. It says I cannot start screen sharing while the other participant is sharing. Can I request who is sharing the screen may stop sharing?
So, good morning, sir. So, will you be sharing the PPT or do you want me to share it from here?
If anybody, I mean, I can also share. I can share
Okay,
if
sir. So,
you
in
have
that
to
case, sir,
give me
you may
right.
continue. All right, sir. In that case, I'll stop sharing and you may continue with it.
Please, please.
Thank you.
Can you all see my screen?
Yes, sir, we
Yes, sir.
can.
Okay. Uh, Good morning to all of you. And I must thank Father Dominic and Father Joseph and Mr. Atish for their initiative and having invited me to deliver a special guest lecture on contemporary issues in auditing. As Shorish has mentioned that I am an alumni, so whenever I get a call from St. Xavier's College, I feel that I got a call from my temple, my alma mater, so it's my bounden duty that I should be present amongst the students. I recollect and connect with my student days when I used to be a student of St. Xavier's College, BCom, maybe only 40 years before. And I enjoy the moments. Unfortunately, this is online, so I won't be able to see you all. Always a face-to-face connect, looking at your eyes, interacting is more effective and fruitful. Nevertheless, reaching all of you in a Saturday morning is always welcome. So thank you very much. Well, I will deal with the topic audit first. And since you all are students in BCom third year, and also maybe pursuing CA course or any other professional courses, and you must be reading the advanced auditing, just to recollect that audit basically is defined as an exercise by a professional, and the basic objective is defined in SA 200. When I say SA, it's standards on auditing. 200 says that the basic objective is to obtain reasonable assurance from its process of examination of the financial statements and to issue a report. What the auditors certify that the financial statements are prepared in accordance with the financial reporting framework, and the audit says that it is free of any material misstatements arising out of error or fraud. Is that right? So that's the basic objective. But you know what has happened over the years? The audit process and standards have evolved. When I was a student, there was audit practices manual, and there was no board even in India or globally. Then the boards were formed. Board means there were participation of many stakeholders, including the regulators from different countries. They do participate. So today you are seeing international standards on auditing or standards on auditing. 2009-10, there was a convergence project, and in this project, internationally, all the standards on auditing were revised thoroughly. These are still being implemented and tested. Why was this done? Because there are challenges thrown to the audit profession, and almost all stakeholders globally said that we are not happy or satisfied with the audits done. I represented ISSB, wherein there was a representative from PIOB. ISSB is the International Audit and Assurance Standards Board, where PIOB, Public Interest Oversight Board, there was a representative who used to criticize hard the standards on auditing, saying that you must enhance the bar, you must raise your, the quality expectation, because the whole world is expecting a lot from the audit professionals, and that actually leads us to rethink about the audit process and procedure, and it's a continuous process of evaluation. Now, while coming to this decade, and we have reached 2025, quite advanced, what are the latest challenges that the audit profession is facing? If you ask me the question, I would say there are three major areas. Of course, there are many areas, but there are three major areas which we can discuss today. And of course, I will take questions from you. The first one is regulatory changes and compliance. Second one is use of automation. Third one is impact of ESG. I'll try to give you a flavor of all those three, how this is being operated, how this is being impacting, and then of course I'll leave it to you for further thought process. As you know, regulatory changes are inevitable, and in India there are multiple authorities who actually try to govern, try to look after the interests of the stakeholders. Ministry of Corporate Affairs, which controls all registered companies. ICAI, of course, our Institute of Chartered Accountants of India, which make professionals like chartered accountants, and they also issue the, today they prepare, and of course NFRA has to issue the accounting standard and auditing standards. We have the stock exchange regulator, SEBI. We have the banking regulators, Reserve Bank of India. We have insurance regulator, IRDA. We have the direct tax authority, CBDT, and of course the GST Council. And overall, over and above, now NFRA has joined the regulators team. NFRA is the National Financial Reporting Authority, which supervises and monitors the quality of audit professionals. Quality of audit profession and professionals, how the audit will be done. They also are issuing standards on audit today. So why this is a challenge? Because if a company today, just imagine a company which is registered company and listed company having business in banking as well as insurance, naturally they are supposed to be taxed, and of course services will attract GST. They will encompass a situation when they are supposed to report to MCA, SEBI, RBI, IRDA, CBDT, GST Council, NFRA, and ICI. They are regulated by all, and every regulator have their rights to share their pound of cake. So in India or anywhere globally, particularly in India, any regulator would regulate through their enactment act, through rules, regulations, and thereafter circulars. So if you are looking at the practical world of accounting and auditing, almost every day a number of circulars being issued by different authorities which throw challenges of getting updated about the changes in this law. Then we have the act, which is a master act, which actually regulates. There are rules and regulations which is annexed to the act, and there would be proviso. And in India there are many cases where you will find one section will have 10 rules and regulations, and then maybe 50 provisos. Provisos are annexed to the particular section of act or rules. And then you have plethora of circulars which also make changes. So one professional would face a lot of difficulties to get himself or herself updated continuously about the changes being brought in. In audit parlance, the changes made, as I said, 2009-10, the entire set of standards were revised, and recently ISSB has issued ISQM 1 and ISQM 2, following which India has also issued SQM 1 and SQM 2. Earlier, this used to be SQC 1. What is the basic difference? A lot, I would say phenomenal changes. SQC 1 was a sketch of the draft, quality control measures by the CA firms, the chartered accountant firms who are auditors. SQC 1 definitely gave an outline, but that was more like quality control. Whereas nowadays it has become quality management, and this has 7 pillars, major pillars. It talks about the leadership and supervision, it talks about the monitoring, it talks about the engagement performance, it talks about the client acceptance and continuation, it talks about the ethical requirements, it talks about information and communication. And it has in-depth analyzed and guided the audit professionals, that is the CA firms, how should they run their firm if they want to do justice to the quality of being in profession. So this is a phenomenal change, and all chartered accountants, those who are pursuing audit career, they should know what is there. Well, at individual level, I should also talk about SQM2. Earlier, there was no standard on EQCR or engagement quality control review. SQM2 deals with EQCR. You can understand there are 2 standards now in place of 1, and EQCR has been given lots of importance because audit has become quite challenging, very strict, very, like expecting, demanding. So the role of the quality control partner, who is actually supporting the engagement partner, engagement team, role of that quality control team has become very important. At individual engagement level, we have SA 220. SA 220 talks about how an engagement to be performed, and the standard is also revised. And it has given a framework of what are the things, how would the engagement team to be decided, who would be the responsible person, engagement partner, what extent time they should involve, what is the client acceptance and continuous process. All these things are defined. We have revised, we means I was part of the ISSB that time, so I say we revised the ISA 540, and as a result in India SA 540, which is audit of an accounting estimates. Now, audit of accounting estimates, when this was revised, there was a need for revisiting SA 315 or ISA 315, which talks about risk assessment, risk identification, and risk classification. So that was understanding the entity and the risk classification. Now the name is risk identification, risk assessment, risk classification. So SA 315 was also revisited. In India, both are issued but not yet implemented. I think the current year onwards, those will be implemented. So SA 315, when it revised, again, there was a sea change. It is not a revision or, changes made in a track change mode from the earlier 315. This 315 is the new avatar. It has defined the risks to be identified in an audit. What do we do? Let's just get back to the risk classification and risk identification process. When an auditor performs an audit, after the formalities and procedures of appointment, acceptance of client or continuation of client and the engagement letter, what is the procedure? They start planning, right? And once a planning is done, planning would include calculation of materiality, sampling, analytical procedure. All these are preliminary stages, right? Thereafter, the main audit on field starts with SA 315 or risk classification. As a part of planning stage, the audit team is supposed to look at the past, based on the past experience, and look at the financials. We call it ABCOT, right? Accounting balances and transactions and disclosures. So look at each and every assertion at the assertion level and try to assign a risk. If the engagement as a whole is classified as normal risk, then assertion level risks are identified as normal, high, and significant, right? Or it could be low. So, uh, this risk classification or risk identification is based on fact, which is called past experience. So it is called fact-based risk assessment, which is to be done as per the standard. Then the areas identified which are significant risk, again it is defined under SA 315. What are the areas, what are the criteria based on which significant risks will be identified? If not significant risk cannot be many, then the audit cannot be pursued. So significant risk, for example, management override of controls is always a significant risk, which is basically done through journal entries. Response to the risk could be looking at the journal entries, or for example, revenue recognition has become a very difficult area. And revenue recognition will have those 5 assertions level, right? Completeness, accuracy, cutoff. So there are areas where one has to be very careful, and looking at that assertion level, one has to identify whether that is a significant, not that every time, every audit, they will identify revenue cutoff as a significant risk. Not that every time, every audit, the team would classify as revenue completeness or accuracy as significant risk. It depends on the particular occasion, particular audit, and based on the past trend. So if the auditor has come on board for the first time, they would basically look at the past, they would make their study, financials and all. And if they're continuing based on their past experience of that audit, they would classify. Thereafter, they would put all the risks in the spectrum of risk and see what is the probability of the financial statements or disclosures may carry a material misstatement. Mind it, the word is not misstatement, it's material misstatement. So any misstatements may not be like in the eyes of auditors. It has to be material, it has to be a misstatement. Both are defined in standards. And based on that, material misstatements due to error, due to fraud, could be intentional, could be unintentional. But if there are material misstatements, auditors should stop there and think about flowing it to the audit report. How do they do the audit report is under SS 700. SS 700, 705, 706 series have been issued following ISAs, which talks about the audit report. There are also changes. Now, I would rather talk on SA 540 a bit, because SA 540 has made the audit wide open. And it has become now mother standard. Let me tell you, mother standard. That was the discussion in IWSP. That amongst all standards, well, reporting standards would follow. Classification of risk is the beginning. Planning, basic objectives, these are the important standards for starting an audit. Materiality sampling and analytical processes are means of audit procedure. But who will guide the whole audit procedure, SA 540? Why? Because it was felt globally that a balance sheet, a general purpose financial statements, which includes a balance sheet, profit and loss account, cash flow statement of changes in equity and disclosures, have almost 80% figures arising out of estimates. Some way or the other, audit accounting estimates have influenced. How, I'll tell you. Look at the balance sheet, the asset side. What do we have? We have property, plant, and equipment. Property, plant and equipment. What is the value? If it is at cost, less cost of implementation, that is cost, no estimates. But if it is revalued, estimation. The depreciation is charged on that, on based on what? Useful life. Useful life is an estimate. If there is an impairment of property, plant, and equipment, impairment is basically seen based on the value in use, which is again an estimate. Then you come to investment, financial instruments based on estimates, because the fair valuation of investments are done based on again estimates. You look at goodwill, again goodwill is supposed to be revisited, estimates. Go to inventory, sundry debtors or trade receivable. Trade receivable is impacted by ECL, estimates. Inventory is valued at cost or NRV, whichever is lower. Again, NRV, what is the source of your information? So, estimates are involved. All cases of financial assets, non-financial assets are some way or the other impacted by estimates. On the liability side, apart from equity and reserve and surplus, generally all the other borrowings and which will include loans taken and long-term, short-term borrowings, long-term, short-term current liabilities are again impacted by estimates. So if that be so, why estimates are so challenging? Because accounting estimates, whenever you do, there are four elements involved. One is there should be a uncertainty, there should be a complexity, there could be a subjectivity, who estimates, and of course management bias. There has to be a trend, it's a reality, it's a practical world. The one who will make the estimates would like to do, if there are two options, they would like to follow the option which is favorable to them. So the auditors will have to be very cautious. Just a second. Sorry, I am having sore throat. Maybe my voice is a bit down. I have to take water continuously. So these four actually throw a lot
I think SAR's link has failed. I mean, it's not in the meet. Saurish, are you there?
Yes,
Saurish
ma'am.
Kundu? I
Yes, ma'am.
think Sir has left. I think some network issues. Just inform Sir if possible.
Okay, ma'am.
Yes, ma'am. Sir has
Okay,
left the
thank
meeting.
you. Yes, thank you. Thank you, Saurish. Thank you, ma'am.
Sorry. Sorry, I think I got disconnected. I have rejoined again, but can someone help me with where exactly I got disconnected? I don't know. I was actually talking. I didn't know that I got disconnected. Can someone help me? To what extent I was audible?
Sir, till this slide was on. The slide is now displayed. This slide was going on.
Okay, and I covered SA 540.
Yeah, you were talking about SF540.
Okay, all right. Then I think I just got disconnected. Thank you so much. So that way, SA 540 has thrown complexity because all accounting estimates would make 80% of the financial statements, and all accounting estimates will have challenges like there has to be a subjectivity, the one who is estimating, there has to be a complexity, there has to be a uncertainty because it talks about the future, and there has to be an element of management bias. And these four, the auditors would look at data, source, method, and assumption. Why data is important? Because all the estimates are based on certain figures, and those figures are based out of past trend, talking about future. So it's important to see how much data, whether adequate data is taken to make an estimates forecast. What are the source? What is the source? If the source is that management has compiled data from here and there, it's not so reliable, right? But if the data source is like an institution like Bloomberg, or maybe from the stock exchanges, the equity price dealing, in dealing transactions in a stock exchange is taken. These are all third party and very difficult to manipulate. So the auditors will have more reliance. What are the methods? If there are complex methods like ECL, or for example, financial instruments valuation, the auditors will see what method the management has followed. And finally, the assumptions. There are plethora of assumptions. If the management has followed assumption which is more acceptable, more popular, convenient, the auditors will have more reliance. If the assumptions are quite difficult, the auditors will again raise alert. So SA 540 actually is a phenomenal change and is a main pillar of all the standards. It's called mother standard, and the auditors will have to be get themselves updated. Then there are changes in CARO, as you know. I need not repeat. The internal control on financial reporting, again, a concept raised, introduced by the Ministry of Corporate Affairs around 10 years back. We have issued a guidance note from Institute of Chartered Accountants of India. There are changes continuously being taken place. These are all like auditing perspective changes from auditing perspective, then of course the IFRS, which is basically again the backbone of Indes, almost every day, every month, research works are going on, and there are certain changes based on our past experience. The corporate governance norm, look at the SEBI LODR, right, which is guiding Bible for the listed entities. Again, there are many changes, and let me tell you, all these changes are basically targeted at um, maintaining the best public interest. Why these changes? Why the stakeholders are so alert nowadays? Because people are involving public money. If somebody has done an investment of his out of his own pocket, own wallet, and running the business, it does not throw a lot of safety and security. It does not throw uncertainty. But if they are dealing with public money, for example, any listed entity, be it equity listed or debt listed, they are dealing with public money. If they have borrowed public funds, that is also they are dealing with public money. So that becomes of utmost importance because they have public interests involved in each and every of their transactions. And of course, the new trend in standards is a very good, I would say, boon of it because it has the scalability. When the standards were introduced, there was no scalability, so there was difficulty in implementation of the standards, both in accounting and auditing. Today, in every auditing standards, everywhere, the scalability is introduced. So, larger the entities of your audit or larger complex the entities, your audit standards, audit requirements will be more. But if it is smaller with less complex accounting assumption, less complex accounting norms, accounting practices, even the audit requirement would be scaled down. So these are the regulatory changes and compliances. Only a few I have talked about. There are many, but of course I believe there are challenges. Now going to the automation, the second area which I think very contemporary. Remember when, you may not remember because when I did my articleship long back, even using of a calculator was very difficult. And I remember neither the institute nor the universities would allow us to carry a calculator in an exam hall because the one who is having a calculator would be in advantageous position. They have to treat all at par equally. So use of calculator was a no-no. And when I wanted to do audit during my articleship, wanted to go for bank audit, I remember revenue audit, my boss has given me a calculator and said, do you know how to operate calculator? Those days, vouching, posting, casting, those who are very seniors would remember, vouching, posting, casting was an integral part of an audit. Calculator came in means a machine. And what is automation? Automation is defined as use of machine, software, technology in your process. That was an automation which started a few decades back. So this automation is nothing new. Then came the concept of cash registers machine or the computers which used to be like one full hall full of machineries making noises and all. And today it's microchip. Today, is the era of AI and ML, artificial intelligence and machine language, and you are the beneficiary. You know what is that? Blockchain concept, robotics, data analysis, cyber risk. These are the big data. So these are the areas which are being talked about. Why this is again important? Because in the operations, again long back, different companies have started automating. We looked at Industry Revolution 1, Industry Revolution 2, Industry Revolution 3, Industry Revolution 4, now it is coming 5. You look at your laptop, all of you must be having a laptop. What is the generation? They talk about i3, i5, i7, i9, 7 generation, 10 generation, 11 generation. Look at your mobiles. Everybody almost has a mobile, and the mobile technology is fast updating, making the earlier mobile backdated, obsolete. So in process, in a company which I am auditing, if the technical process has undergone sea change by use of automation, as an auditor, again, this is a challenge because I have to understand the entity, I have to understand the process, I have to look at the useful life of the plant machinery, and if that technology makes the machinery redundant in 5 years, then I cannot say a plant and machinery, the useful life is 15 years. It has to be 5 years, right? Similarly, how do they maintain data and keep their books? ERP is used. Yes, ERP, use of ERP is also nothing new. Whether SAP, whether Oracle, JD Edward, I mean, there are so many. And one has to understand what is the software they are using and how does it work. Because this software actually will throw the information produced by entity, which is again a backbone of our standards on audit called IPE, or information used for control purposes. One has to look at the management control, one has to look at IP and IUC, right? Come to the accounting and financial reporting, one has to understand the processes. What are the processes normally a company follow? P2P, procurement to pay, O2C, order to cash, inventory control, the property plant equipment, the fair valuation, goodwill, impairment, going concern, direct deferred tax assets, all these calculations, computations, the management will assess based on future projected cash flows, right? That gives the value. One has to do a present value of the cash flow to be generated by its assets. And ultimately, both management and auditors are trying to do two things. One, safeguard the assets and freeze the liability. And at the same time, valuation of those assets should be appropriately estimated or appropriately reflected in the financial statements. That's the purpose of accounting, financial reporting, or audit. So here also, how much the management would use automation is very important for an auditor to know. If there is no ERP, today you must have heard about the concept of audit trail, which is mandated by the Companies Act. The audit trail again is nothing new, it is there. Good ERP will always have the audit trail. But if the company management does not follow a good ERP, because these are expensive, so it depends on the size and volume of the company you are auditing. A small company may still maintain their accounts manually or on an Excel basis, or maybe some local software. But smarter or larger the software, there are many modules involved, so information generated is more reliable. But at the same time, auditors will have to look at the system control. So system audit has become important. ITGC, we call it, Information Technology General Control, and business controls. If the management controls in the system is perfect and cannot be tampered with, nobody can break other than the database administrator. To that extent, if the auditors get comfort, at least the information produced by the entity is more reliable. And we look at the information produced by entity and do all the processes to conclude whether there is a misstatement, material misstatement due to fraud and error. Then it's important to look at the audit procedure and technique. I talked about ITGC and BC. Believe me, in the audit procedure also, after you understand the management process of automation, the auditors will have to look at their own use of automation or technology or software. For example, there are many data analytics which actually take the whole universe without thinking about a sample, take the whole universe of data and start processing, throws as output the trend analysis, which actually would which actually give a benefit to the auditors to come to a conclusion whether there is a spike, why there is a spike. They will ask questions to the auditor management, and if there are spikes, they would analyze whether there are unusual entries, whether there is a probability of misstatement. So looking at that, I have also used many data analytics tool, Power BI and all. Your conclusion will be further reliable. That's the advantage or benefit of it. For example, another example, physical verification through drone. There are mines company, and I remember I did it in one of the iron ore mines, iron ore processing company, manufacturing company. They had mines, and they extract iron ore. Then they either sell iron ore or process it to steel, right? Majorly, this was steel manufacturing company. But the iron ores, the mines are absolutely in a deserted place. They take out extract which is very rough, and they make dams inside the near the mine, so it will be inside forest or somewhere. Human intervention is very difficult. You cannot carry your audit teams to everywhere to look at the physical stock and measure. So drones were used, and the drones will go, move around, identify the dams, take their measurement, length, breadth. Of course, the management will have to arrange it, and they, based on their measurement, they will give the volume, and based on the density, they will convert into weight. So, for example, physical verification was possible first time through use of drones. Is it not use of automation, highly sophisticated technology as an audit tool? This is apart from your data analytics or Excel analytics, which normally the auditors would sit at office and do. So use of automation both by the management and the auditors are significantly influencing your audit process, audit procedure, audit techniques, and finally the audit conclusions. This has both part of it, like if the software and technology are used with good intention, honestly, and with all ethical requirements, then it's a boon. It can create havoc. But let me tell you, if management is unscrupulous, if they do not use it honestly, or the auditors would do it honestly, then it will go against the ethical requirements and it will create disaster. So both ways one has to look at it, and one has to be very careful. That's why it's a challenge, not only opportunity. I come to the last part, impact of ESG. You must have heard a lot about ESG, environment, social, and governance. Why this is important? I would say this is extremely important. Use of automation technology is definitely throwing challenges, but manageable. But ESG is something not in our hand. Look at US having fire in California district or state or Los Angeles. This has become almost annual phenomena. Every year there is fire, and now this is spreading, losing human lives and assets. Look at the ice snowstorm has become ice storm nowadays. Even look at the countries in South Asia. Is it not that the coastal area of Bangladesh, Bengal, Odisha, Andhra Pradesh affected by storm, cyclone almost every year, once or twice? The countries have started giving names to the storms and cyclones. These are all natural phenomena. Somewhere there is mine, suddenly there is some earthquake and the mine will go down. You don't have controls. So climate change is something one has to look at. And of course we can contribute, because whatever we do ultimately emit carbon dioxide, ultimately emit gases which actually impact human life and lifestyle. Every day you eat, you consume, these products are manufactured by some company using water and emitting carbon dioxide. You wear a coat, jacket, trouser, shirt, these are all manufactured by a company where they are emitting carbon dioxide through the machineries, operation in machineries, and it uses water. Water is in scarcity. Tomorrow water may not be there. Tomorrow, more gases will impact human lives. So there are physical risks and transitional risks. But why am I talking about in case of financial reporting and audit? This is actually a summary of ESG. I'll skip that. See, we talked about useful life. We talked about depreciation. We talked about property, plant, equipment, impairment, right? These are all with an assumption that the company is a going concern. The company entity I am auditing is a running concern, and this will go on. So a plant machinery, when it is erected, installed, the manufacturer will say this will continue for 30 years. Now, management will calculate their depreciation based on 30 years. You may challenge the Companies Act says no, 25 years. Fine, they will make it 25 years. But if that company, the manufacturing entity, come manufacturing facility is situated in a place which is fast eroding, or there are natural calamities every year, the company may have to pack up or remove that. You cannot say that the plant machinery, or maybe it gets rusted. In coastal area, all plant machinery get oxidized, so they get rusted. So all those factors will now have to be considered by management and auditor, and see whether the useful life is 25 years or 15 years or 10 years. One is the depreciation. More importantly is impairment of assets. In case the business does not continue, for example, you had a business in Iran, suddenly there are political imbalance. One has to pack up. So immediately impairment will come in. Discontinuing operations will come in. You have a product which is going to, for example, Russia. And Russia, there are sanctions. India has not given sanctions, but if there are, so your product will not get sold. Immediately there will be sanctions. So immediately the management and auditor both will have to think about, one, the impairment of assets, two, the going concern assumption. If the going concern assumption is affected, the same cash flow will be treated, will be considered for calculation of deferred tax asset. If the company has deferred tax asset, and if they want to continue with that, they have to justify that there is enough cash flow so that the deferred tax asset would be adjusted. And if that is not, then it has to be provided for, charged off, right? So this is one more area where cash flow projections will be important. Well, the company has to secure debts or borrowings. Let me tell you, there are companies, all companies are classified based on how much carbon dioxide they are emitting and how much they have done, they have expended to manage that, based on which the industries are classified. For example, petroleum industry, oil and petroleum industry, maximum pollution; iron ore, coal mine, maximum; thermal project, maximum. Whereas the banking and financial services or service sector may not emit. So based on scale, the authorities have classified which one is more vulnerable, which one is less. The bank, RBI is considering, and I think some banks have started to issue green loan. So the company will get a lower rate of interest, more facility in securing, fund from the market or public financial institutions, which is very beneficial to run a company if they are managing their carbon emissions or ESG requirements well. The companies are mandated, the listed companies are mandated to come out with a report and disclosures called BRSR in India. Globally, there are standards, and the companies have to disclose how much they are spending, what they are doing, and how they are going to take this challenge, based on which the securing debts and borrowings will also depend. The investors will feel safe if a company is a going concern even after considering ESG. So they will get direct equity. Revenue recognition, again, at the inception, one has to know that they will recover the money. Now, in a 1 year cycle, perhaps you can still think, but if there are revenues which may be recovered in 3 years, 4 years, one has to look at the possibility and feasibility of the company being run, right? So the disclosure requirements will be many. The operational performance metrics will change. The governance and risk management, the directors will be directly involved to run a governance model for those entities where ESG is not so important, or ESG is not given so much of importance. So this will also actually affect. If you look at the earlier slide, I have actually summarized. Environment, we know that there are greenhouse gas emissions, air quality, but see, look at social capital, human rights, customer privacy, data security, access affordability, product quality and safety, customer welfare, selling prices. They should be honest in making a sales. They should not give incidentally wrong information about the product. Business models, so product design, life cycle, everywhere, leadership, governance, human capital, everywhere the company has to consider the ESG, and accordingly they will select the alternative of their process, production and operations. Accordingly, the financial reporting and the valuation will also undergo change, and entire accounting norms and audit norms are based on audit of accounting estimates, which will actually be impacted. the auditors will have to decide about their professional judgment, right? Because there can be management bias, the auditors will have to do a lot on their professional judgment. And once the auditors think about judgment, you can understand more the professional judgment, less vulnerable would be their conclusions. So, if again there can be a subjectivity, an auditor's opinion may differ from another auditor's opinion. We cannot leave a position like that. So there, I think it's a challenge where the institutions, the regulators will have to do a lot. But individually as auditors, I think we have to accept this as a challenge and we have to adapt to the new norms. We have to be on alert. We have to see what are the changes taking place and accordingly we have to do our conclusions. Thank you very much. I think I have taken a lot of time and sorry for the interjections in between, but this was my presentation. Thank you very much. If you have any questions, I can take a few. Thank you.
Thank you so much, sir, for the very insightful session. I do have a question though. You talked about SEBI LODR, and recently SEBI came out with a consultation paper requiring statutory auditors to submit a report on digital assurance, which is in line with ICAI's publication of Technical Guide on Digital Assurance. So, could you please shed some light on what is the difference between digital auditing and auditing digital? These two terms, if possible.
Well, that's a very good question. Again, a very contemporary issue, but SEBI actually has not mandated as yet. SEBI has just come out with a consultative paper. The other day, we were discussing with SEBI chairperson, and she has appreciated the ICI Digital Assurance Guidance Note, where actually, apart from the auditing standards and technical guides on audit of technical matters, the ICI has found out certain areas where it's more like intangible, but the auditors could still certify. For example, if the company has adopted a software and the software has, as I said, ITGC and business control, or there are some areas where how much the company has done the process digitally, the auditors will have to certify. So SEBI has expressed their satisfaction on that and they have issued a consultative paper and they are seeking public opinion on this, whether to mandate or not. That's the position today. And chairperson actually said that I liked it, but again, I'll not go. I would like to go with the public. So they have issued a consultative paper, I think 2 days back. If you want to know
Yes, sir, that
further,
answers my question.
can you refer to that ICI Digital Assurance Guidance Note, which actually has explained in detail? That will take time.
Yes, yes, I will. Thank you so much. So I don't think there are any further questions. So I think the vote of thanks will be given by Professor Dr. Srimoy Kuhorai. So over to you, ma'am.
Yes. Thank you so much, sir. And so these are the central lectures which are generally organized for the sake of academia industry interface and provide our students to peek into the practical application of their classroom theories. And such an imperative exercise could not have been possible without the cooperation and support of the administration. It is my pleasure to thank Reverend Dr. Joseph Pulandai, our Vice Principal of the Morning Section, Postgraduate and Research Department of Commerce, for his enthusiastic support and encouragement. I would further thank the Dean, Dr. Amitabh Roy, BCom Morning, for his understanding and suggestions for improvement. I'm also pleased to thank Dr. A.P. Mondal, our Head of the Department, Accounting and Finance, for offering us a chance to organize such lectures. I further thank the professors of the department without whom such an event would not have been possible, and the non-teaching staff for handling the back end of holding such online sessions in a seamless experience, and the students themselves for the time and attention. And our MC for today, Shorish Kundu, thank a word of appreciation for him as well. Thank you, everyone. Thank you, sir. That's all from my side.
Thank you.
Sir, I would just like to add, I would like to thank you, sir, our speaker, for giving us this extremely, I would say, clear understanding of the recent changes. As professors, also professors of auditing, as I would say, students of auditing as well, we learned a lot from you. Thank you so much, sir. Thank you for being here with us. Thank you.
Thank you so much, Riley.
Thank you, everyone. With this, we come to the end of the session. Students are requested to make sure that they fill the Google form in order to get their attendance marked. And we end the session here. Thank you, everyone.